Hello guys, it's Castaway Trader and welcome back to my YouTube channel. Today it's a new video lesson. I add that video lesson to my second video course, which is called Trade Like a Pro, and in that course you will be able to study the harmonic Elliott wave theory and its application in trading in much more detailed way. The first course is just for the beginning. You learn the main principles, the main rules, and the second course would let you to become a real pro, because this is where I go deeper into details. So that lesson is called Dealing with Numerous Scenarios, and it is based on the current situation in ES Mini. This is exactly what's happening now, and I'm sure it will be interesting for you. Let's start first from reminding you about the disclaimer. Please read it carefully. Past results are not indicative of future profits. I'm not giving you any investment advice. It's only for educational purposes. Normally, when we track a corrective pattern in the market, we pay attention to that main fractal, which is a ABC down flat corrective structure. We call it 335. 3 waves down, A, B, C down is followed by 3 waves up, A up, B down, C up, and finally that whole ABC down structure is concluded with the 5 wave down move. Why it's important? Because if you want to take advantage of a temporary pullback in the market, you really want to know when you can expect the completion of that whole ABC move down, because what normally follows is another strong impulsive move up. But not all the time you have that pristine, clear corrective pattern, which is very easy to track and very easy to trade. And in that lesson, I'm gonna show you what other options we can face when we track a corrective pattern. And sometimes, and I'm gonna show you based on example what we had only yesterday on Sunday, October 3rd, 2021, sometimes you could actually identify several alternative patterns, and the main question for you is how you're gonna trade that uncertainty. You would like to have only one scenario and you would like to stick to that scenario. You would like the stock to closely follow that scenario, and that would be easy way to make money, but it does not happen all the time. And this lesson is about that way, how you actually manage the uncertainty and how even under that uncertain situation you can actually make a good trade. But before we start, I want to remind you that that lesson is a part of my video course. You can read more details on my website, castawaytrader.com education. You pay only once and you get a lifetime access to my video course. It is hosted on platform Udemy, the largest educational platform in the United States and probably in the world. And it's available for offline downloading in Udemy app. And you have 30-day money-back guarantee. You can get your money back without any questions asked if you don't like it. So normally I charge for that course $149. So the regular price is $199. But for only 5 days, I offer you special opportunity to subscribe for $99.99. Great opportunity. You pay only once and you get access for dozens, it's probably 100 video lessons there, several hours of video lessons. You can read reviews. I will add a link to that YouTube video and you will be able to read reviews of actual students. It's one of the highest rated Elliott wave course on the whole Udemy platform. Now let's get back to business. I told you this is the standard corrective structure. This is where we normally start from. We always assume that a corrective pattern would be following closely that structure, but not all the time. Let's see how it happens. So this is a corrective structure that started at the top of early September 2021, and it looks like 335 standard flat corrective structure. Look, ABC down followed by ABC up. This is wave A, this is wave B up, and we would expect 5 wave down, right? Because this is what our fractal tells us, 5 wave down. In that particular case, we got a strong corrective bounce on Friday, October the 1st, and it retraced slightly more than 50% of the drop in wave 3. It's kind of a textbook target for a corrective wave 4, and at that point, under that scenario, we would expect another push down in microwave 5, and that push down would complete the whole A down, B up, and C down structure. And the most important thing here on that chart is that red arrow, because normally we would expect wave C to drop and tag at least 100% extension of the first leg down. So at least we should be equal. In many cases, wave C would be stronger. It would extend to 123.6%, so it would be 23% longer than the first leg down, or even to 176.4%, so it would be longer by 76% than the first leg down. So you need to see, once you have full 5 wave down structure, microstructure of that second leg down, and you keep monitoring those major extensions of the first leg down. This is how we normally are able to nail a completion point of the second leg down. Now, on Sunday evening, I had to write a report for my subscribers, and I was going through different scenarios. One of the scenarios was to consider the whole structure as WXY structure. And WXY structure, it differs a little bit from simple ABC structure. If simple ABC structure is 3 down, 3 up, and 5 down, WXY structure would be 3 down, 3 up, and 3 down. And if we look through that angle, we could have said that the whole structure, the whole corrective structure, looked like it bottomed, and the first push higher on Friday was start of a new 5 wave up rally. And that was my scenario 3, the least probable alternative bullish scenario. It was not the most probable one, and the reason why it was not most probable one, because I've just mentioned that the second leg down failed to take 100% extension of the first leg down. So that second leg down looked short in comparison to the first leg down. So that was scenario number 3. And the conclusion from that case is that you should always doubt a corrective count where the second leg down did not take 100% extension of the first leg down. There will be cases when the second leg down would bottom at 76.4. It would be a shorty one. But in majority of cases, the second leg down would be at least equal in size to the first leg down in wave A, or in that case in wave W. My first and primary scenario was bearish. As I mentioned, I could consider it as an ABC flat corrective structure where the second leg down would need to make one more push lower, because the corrective bounce on Friday, October the 1st, actually had a clean A up, B down, C up, a textbook corrective structure, and it tagged slightly higher than 50% retracement ratio of the whole decline in wave 3, which is a textbook pattern of a corrective wave 4 that should be followed by another push down in wave 5. Let's come back to WXY corrective structure. Sometimes you have simple WXY corrective structure. For example, that could be 3 down, 3 up, and from here it could be 3 down. And at that point, it could have bottomed, but the problem again, you see, it was kind of short. It did not extend at least to 100% extension of the first leg down. This is why sometimes that wave in the middle gets very complex. You see, that ABC up was only the first leg up, it's W itself, ABC down, wave X, and another ABC up, wave Y, and together we made 3 up, and we label it as X in parentheses. So we got 3 down, 3 up, and finally 3 down. And this is an actual example how that complex structure could work out. This is S&P 500 30-minute chart from February to March 2021. Again, the same year we had that complex structure. And we got first 3 down, WXY, and then we got that tricky running flat structure. It's tricky because the corrective move down in X managed to make a new lower low, and it felt like we are starting that second leg down and only to turn up again. And at this point you can see it did not make 100% extension of the first leg down, and the majority of traders here believed that a new rally started because we got 2 legs down separated by a corrective ABC bounce, and we started a new leg up. But look, the tricky part of that is that that rally actually stopped without making a higher high over the first leg up. Look, we are talking about this one, this zigzag. That was the first leg up, that was the second leg up, and the second leg up failed even to retest the top made by the first leg up, and then it collapsed. But look how it collapsed. It collapsed not in 5-wave down structure. We could have counted as 5-wave down structure. We could say it's ABC of 1, that's a tiny 2, ABC of 3, that's 4, and this is the crucial point. At that point, you would think that you are counting a simple ABC structure where was 3 down, 3 up, 5 down, and what was it? That bounce looked like a textbook wave 4, because we got 1, 2, 3, 4, and you would expect one more low. You would expect one more low and you would miss the bottom. This is why you need to understand that sometimes when you track a simple ABC down, you may be dealing with a more complex WXY structure. And in WXY structure, you would not get that perfect one more lower low scenario. You would have that structure bottomed with the largest push down, which is kind of counterintuitive because many people believe that we should get a positive divergence on oscillators, and the positive divergence, how it is generated, is when you get the final push down which is smaller in size than the previous one. But in that particular case, I don't think you would get a positive divergence, and many people would miss that bottom because we would be counting it as micro 3, micro 4, and here we would be waiting for 5 down. So on Sunday I said, look, we could have been here and we could get another push high in ES Mini. Look how that scenario would work on ES Mini. So this is the actual chart as of October 3rd. 3 down, and we got ABC to complete 3 up. If it followed the same pattern as in February, we would need to get a corrective pullback of Friday top. It would be micro sub with B down, followed by another push up, and that would be ABC up, and together that ABC up would complete the second leg. First leg down, second leg up, and the third leg down. So that was a feasible scenario. That was scenario number 2. Remember, scenario number 1, pretty simple. We are tracking a corrective ABC down, and we expect one more push down in the microwave 5 of wave C. The second scenario is that one, very tricky, but as I've just shown you, sometimes such a complex pattern plays out, and we saw that pattern to played out by S&P 500 earlier this year, 2021. So it was a long shot, maybe it was too complex. You know, the simpler the structure is, the more probable it will play out. And when even we deal with a simple ABC down structure, like in that particular case, S&P 500 30-minute chart, September-October 2020, we normally would expect wave 5 to have ABC subdivision. So in that particular case, we are getting that 3 down, 3 up, 5 down structure. And in that 5 down structure, the trickiest part is that wave 1 has ABC subdivision, wave 2 has ABC subdivision, wave 3 has ABC subdivision, and wave 4 has ABC subdivision. But wave 5 lacks ABC subdivision. And again, it's a big warning for you, so you should not be a purist. You should be prepared for imperfect completion of the final push down in wave C of a corrective ABC down structure. And that imperfect completion could be lack of ABC subdivision in the final push down in wave 5. So what was my conclusion in that weekend report? I said, look, we have 3 scenarios. It's not good news. You don't like to have so many scenarios. I understand that. The good thing is though that every single scenario we discussed, the bullish number 3, WXY number 2, or simple ABC down number 1, they all expected move down of Friday high. And that actually created a trading opportunity, because no matter how many scenarios you have, if all those scenarios argue for a move in one direction, even of different magnitude, you can trade it. And as we know now, we got the decline into Monday morning. The funny story is that even as of now, on Monday evening when I record that video, we still can consider the WXY complex structure as a feasible scenario. Because look, we got 3 down and it could be 3 up, but as in the same example as I've shown you, it could be A, B, C, and only here in that red zone that wave X would top, and it would be a setup for another decline in wave Y down. So that scenario is still on the table. That simplest scenario actually promises the quickest resolution, because the 100% extension of the first leg down in wave A is located at 4,225. It could extend a bit lower, but that scenario offers the easiest resolution, because all bulls need to do is just to push one time lower. And remember, I just shown you that sometimes we do not have perfect structure in the final leg down in wave C. For example, in that particular case, we do not have perfect subdivision in wave 1, especially if we look at 240-minute chart. But it should not be perfect. So it's a feasible scenario that overnight ES pushes down to 42.25 and it finally completes the whole ABC move down. This is another structure. We can count the very same structure as another WXY structure, where that ABC up was all of wave X. And if it was all of wave X, we need to expect 3 down. ABC that was leg down, it was the first leg down, then pullback in X and another ABC down. That structure actually provides us with better tools to make focused about a potential bottoming zone, because wave C in any ABC structure should relate to A. And we would normally look at 123.6% extension, 138.2% extension, and sometimes it bottoms at 114.60. And again, we pay close attention to that 100% extension of the first leg down and 123.6% extension of the first leg down. And I want to remind you the second takeaway from that lesson. Always doubt a corrective ABC count or WXY count, where the second leg down in wave C or Y did not tag 100% extension of the first leg down in wave A or W. In majority of cases, the market will come back and make one more push lower to tag that 100% extension. And let me show you again that case when it really looked like the market bottomed here in A down, B up, C down, but because it did not tag 100% extension of the first leg down, and it started to go up, but the market kind of left unfinished business behind. And normally this is what bothers the market. Then market turned down and completed that structure. It kind of resolved that problem. It fixed that unfinished business left behind at that stage. Thank you for your time. Good luck with your trading.